US has seized two more tankers linked to Venezuela. So is this the start of a new era for the oil markets? The US military seized two tankers in the Atlantic Ocean on Wednesday, one sailing under a Russian flag and another off South America that was fully loaded with Venezuelan oil. The US says both ships belong to a shadow fleet of tankers used to transport sanctioned oil from Venezuela, Russia and Iran. Naveen is a senior oil analyst at Kpler. Naveen, this shadow fleet has become a crucial part of the global oil trade, hasn't it? What happens if the US continues to crack down on these ships?
Since 2018, 2019, the shadow fleet has expanded, again, as you mentioned, carrying sanctioned oil around the globe. Last year, it accounted for about 27% of global transit, especially on larger vessels. That being said, the total volume of exports of oil that the shadow fleet did carry was somewhere around 14%. So, quite a few tankers, older tankers doing not so much work. I think the issues with the shadow fleet has been that when the sanctioning has come onto them, it's been sort of mixed and split. So OFAC and the US have primarily sanctioned Iranian oil tankers and Venezuelan oil tankers, or tankers that carry this oil, whereas the EU and the UK have sanctioned tankers carrying Russian oil. Some of these tankers can be flexible as well, switching between taking sanctioned oil and non-sanctioned oil. So enforcement and the governments or the US getting onto vessels and grabbing sanctioned oil vessels does send alarm bells for the shadow fleet.
As you said, the Trump administration now says the US is going to export and refine Venezuela's oil itself. What does that mean for the global market and perhaps particularly for China, which was the main customer, of course, before?
Indeed. So much of the Venezuelan exports were headed, on sanctioned vessels to China. Somewhere around the 600,000 barrel per day mark we were seeing the back end of last year. This is effectively stopped. Kpler data shows that this was basically down to zero due to the blockade in December. But as mentioned, China has a lot of optionality. A lot of barrels, not only Venezuelan, but also Iranian and Russian, are sitting in floating storage around the globe, some of it outside of Chinese ports as well. So there is access to quite swift replacement barrels.
The White House has invited energy bosses to a meeting at the White House tomorrow, but how willing are US oil companies to put in the vast sums of money it would take to exploit Venezuela's production?
I mean, that's the great question. That's the $1 million, maybe the $1 billion question. I think the headline that surrounds Venezuela is, the world's biggest oil reserves, reportedly over 300 billion barrels. There's maybe a little bit of a question mark over that in terms of at the time of President Chavez, maybe inflating some of these reserves. And some of these reserves are very hard to reach and to extract. So I think that's the crucial point. The Venezuelan oil is very heavy, sour. It will take a lot of additional, if you want, energy, manpower, technology to extract that oil. And typically heavy sour oil also sells at a discount to lighter grades. So that there is, on the one hand, this big, bonanza potentially of these reserves, but the additional costs for extracting heavy oil, maintaining the power grid and the supporting infrastructure needed to extract Venezuelan oil, improve and rebuild the existing infrastructure which has been underinvested in for so much time. These are the sort of longer term and medium term decisions that need to be made by US oil companies. I think what will be crucial for them, and it's been already mooted by President Trump, is that the US government would offer some sort of financial guarantees, because above all else, political stability in Venezuela is the big question mark for US oil companies coming in there. Will they be able to invest over 5-10 years? And we're looking at sums, around $10 to $15 billion a year over the next 5-10 years.
How much could the return of much of this Venezuelan supply to the market depress global prices, do you think?
Well, I think there's a two-phase approach here. I think in the short term, the blockade that the US has put on the exporting cargoes has meant that domestic storage capacity in Venezuela is rapidly getting used up. And we've already started to see a bit of a drop in Venezuelan production, around 150,000 barrels per day. So in the short term, it's actually tightening up the market. but as I mentioned before, in a sort of global glut. And then we're breaking it down into phases here at Kpler. Short term, a bit of a reduction in supply. In the next 3 months, if we start seeing, Chevron being able to expand its waiver in the country and, operate more freely, we could see that Venezuelan supply jump up to around 1 million barrels a day. So up sort of 150 to 250,000 barrels a day from the current mark, and then getting up to maybe closer to 1.5 million, 2 million barrels by the end of the year. So this is already adding oil into an already long market. However, price action on the back of this has been quite remarkable in the sense that prices have not depressed so much, because whilst we are seeing maybe a fundamental move to more oil, traders in the market are wary of the geopolitical risks that are going on not only in Venezuela, but what does this mean for Iran, Russia, other sanctions, the grabbing of sanctioned tankers. So the geopolitical risk is offering some support to the fact that fundamentally we might have a longer market, keeping things relatively balanced for now.
That was Naveen Das of Kpler. Don't forget you can watch more videos on Reuters.com.